lock in. So thank you all for taking the time to join us this evening for Business Pathways webinar, Maximizing Your Clinic Success, a guide to moving, expanding, or transferring your clinic, hosted in partnership with Watson Gopel. I'm joined by one of the associates from the business group, Mitchell Cunningham, an industry expert focusing on areas of business, real estate, and real estate and trust. His colleague Cameron came to present on the two previous webinars in the series on incorporation agreements required for clinic, as well as leasing and owning a practice from a legal lens. So if you have missed that, you can find the recording and the slide deck on our virtual events page. I'm speaking to you tonight from Richmond, not so sunny. I would like to acknowledge that the land on which I reside on is the unceded territory of the Coast Salish peoples, including the territories of the Musqueam, Squamish, and Tsleil-Waututh Nation. I know that we're all from various locations around BC, so thank you for taking time to be here and for the land you're presented with tonight. So on to housekeeping. The session will be recorded and posted on our virtual events page, as I said before, along with the slide deck, and you can refer this at any time or recommend it to your colleague or your staff if you find this helpful. So everyone's muted on entry. Thank you for submitting your pre-questions. Mitchell has reviewed them and answered some of these within the presentation as best he can. We do have some time for live Q&A at the end, so please use the Q&A function on the Zoom toolbar if you have questions for our presenter. But as usual, each scenario is case by case, so there might not be a definite answer. So it's best to seek out professional help, such as a lawyer, accountant, or for your financial matters. There will be a quick survey that pop up as you exit the webinar, so it'll be emailed to your registered email as well. We have updated to a shorter format to collect your feedback, so it would be appreciated if you complete it to improve our future sessions. And so back to tonight's session, Mitchell will talk about moving, expanding, transferring, closing down your clinic, such as the requirements, how to prepare the sale of assets, pros and cons on selling your clinic to another entity, or recruitment of new physicians if you want to transfer, expand your current practice. And with that, I'll pass it on to Mitchell to go over tonight's session. On to you, Mitchell.
Great. Thank you, Walter. It's a pleasure to be here. As Walter mentioned, I'm presenting on Maximizing Your Clinic's Success, a legal guide to moving, expanding, or transferring a clinic. So just a quick disclaimer before we get started. This presentation is for informational purposes only and does not constitute legal advice. The content provided is general in nature and may not be applicable to your specific circumstances. It is not intended to create, and receipt of it does not constitute an attorney-client relationship. Before making any decisions or taking any actions based upon the information contained in this presentation, we strongly encourage you to seek the advice of a qualified lawyer. And I'd be happy to take a consultation and either help you out with any questions that you have or refer you on to somebody else. So please let me know. So about me, my name is Mitchell Cunningham. I'm a lawyer at Watson Gopel, practicing in the business law group. I do business, commercial, corporate, real estate, wills and trusts, pretty much a general solicitor's practice. Tonight, I will be going over the following topics: growing an existing clinic, structuring the acquisition or disposition of an existing clinic, due diligence in an acquisition, valuing an existing clinic, tax considerations in an acquisition or disposition, employment and labor considerations in an acquisition or disposition, and College of Physicians and Surgeons of British Columbia requirements for leaving practice. So, growing and scaling an existing clinic. The idea with scaling or growing is to structure and operate the clinic like a business from the outset and grow it in a similar way, which is easier to do if you're offering private medical care. Some considerations for growing or scaling an existing clinic include patients, personnel, space, intellectual property, and operations optimization. In the early stages, growth is often the primary objective and is typically achieved by adding more patients, as growing the patient base will increase revenue. However, increasing the patient base will also create a greater demand on the provider, requiring more time and other resources, and revenue will ultimately be limited by the number of patients you're able to see. So, once patient demand surpasses available resources, it will be time to consider recruiting additional personnel such as physicians, nurse practitioners, nurses, and other healthcare providers and support staff, allowing the clinic to serve a greater number of patients and reducing the burden on the owner-operator to provide care while maintaining full ownership. If your existing location does not have enough space to accommodate new providers and patients, then it will be time to consider expanding or moving the clinic to a larger space or opening additional locations. This can be achieved by either leasing or purchasing additional real estate. If you're looking to lease additional space, my colleague Cameron presented on leasing at the last webinar, which is available through Doctors of BC. And I suggest engaging the services of a commercial leasing agent to assist you with finding premises and negotiating the business terms, such as price per square foot, but ultimately having a lawyer review the offer to lease and the lease prior to execution. If you're looking to purchase additional space, you can reach out to me or one of my colleagues for an initial consultation, and I suggest engaging the services of a commercial realtor specializing in the area of medical office space. So prior to growing or scaling your clinic, it will be important to build a brand and optimize operations by cutting down on costs and increasing operational efficiencies so that the clinic retains a greater portion of revenue and the owner receives a greater profit. At this stage, it will be critical to review the clinic's physician services agreements and other independent contractor agreements and consider the fee splits in light of the clinic's overhead. When looking to grow or scale a clinic, it might be prudent to engage the services of a business consultant. Another way to grow or scale your practice is to acquire an existing clinic. The roadmap is generally similar in any sort of acquisition. You need to identify the target, conduct due diligence, negotiate a non-binding letter of intent, negotiate a binding purchase agreement, and then close the transaction by exchanging closing documents and funds and transferring the assets or the shares. So there are two common forms used to structure acquisitions and dispositions of clinics in Canada: share purchase transactions and asset purchase transactions. In a share purchase transaction, the buyer purchases all or substantially all of the issued and outstanding shares of the target clinic's management corporation from its shareholders. This form is only possible where the clinic is actually incorporated. An asset sale involves the purchase of certain assets and often the assumption of certain liabilities of a clinic without acquiring the entity that owns them. An asset purchase transaction is typical when only a single clinic or division is of interest, or the new owner wishes to cap existing liability exposure. Other more complicated structures can be used when the circumstances require. For example, a hybrid asset share transaction or an amalgamation. For tax reasons, buyers generally prefer asset transactions, and sellers generally prefer share transactions. I will discuss this point further later in this presentation. Asset transactions are generally more complex than share transactions because they require parties to obtain consents and to transfer a number of diverse assets. Asset transactions may be the only practical structure where parties want to transfer some but not all of the assets and the liabilities of a clinic. Further, the additional due diligence required for a share transaction may necessitate a longer period between signing and closing. If you are considering buying or selling an existing clinic, then it would be prudent to engage the services of a lawyer and an accountant or other tax planning professional prior to executing a letter of intent or a purchase agreement. There are certain situations in practice where we are not involved at the outset, and then the structure of the deal needs to be amended at a later date, which causes significantly more cost and energy and headache. So you might think that it's more efficient or more cost effective for you to hold off on engaging certain professionals at the outset. But I assure you that those costs will come back in the end. So be proactive. Due diligence in an acquisition or disposition is the process undertaken by the buyer to familiarize itself with the business and the assets of the seller or the target clinic. The level of due diligence varies depending on the nature and industry of the business being acquired and other legal and business considerations, and is dictated by the structure of the acquisition. In a share transaction, legal due diligence typically involves reviewing the target clinic's financials, accounting and taxes, operations and management, corporate records, intellectual property, government records, and each contract or agreement that the target clinic is a party to, and searching registries and databases for corporate status, encumbrances on assets, and active court proceedings. In an asset transaction, due diligence is similar, but focuses more on issues related to the specific assets being acquired and liabilities being assumed. Typically, the operations due diligence is performed by the buyer, and the legal and financial due diligence are performed by the buyer's lawyer and accountant, respectively. It will be important to determine the fair market value of the clinic in question, which is defined as the highest price expressed in terms of cash equivalents, at which property would change hands between a hypothetical willing and able buyer and a hypothetical willing and able seller, acting at arm's length in an open and unrestricted market, which neither is under compulsion to buy or sell, and when both have reasonable knowledge of the relevant facts. So in the case of a clinic earning a sufficient revenue, the fair market value is generally determined using a going concern assumption with primary reference to expected earnings or cash flow, and secondary reference to the fair market value of the assets owned and used by the clinic. Valuation can be a very complicated process, and establishing a purchase price for an existing clinic is an important step in any acquisition or disposition. It would be prudent to consider hiring an appraiser or business broker, or engage the services of your accountant or a chartered business valuator to determine an appropriate purchase price for either the target clinic or, if you're selling, for your clinic. There are also a number of tax considerations in an acquisition or disposition, which include income taxes and sales taxes. As I mentioned before, I'm circling back on taxes now. Income taxes, or the income tax consequences, are often a determining factor in structuring a transaction. Tax implications should be reviewed early in the negotiation stage with a qualified accountant or other tax planning professional to determine the tax impact of buying assets or shares. From the seller's perspective, the seller should compare the net after-tax proceeds from an asset deal versus a share deal. When an incorporated seller sells assets, the net after-tax sale proceeds received by the corporation will be taxed again when the corporation distributes those proceeds to its shareholders. Therefore, depending on whether and how proceeds are distributed from a corporation to the shareholders, there will often be additional tax payable by the shareholders. To determine which is the better option, the seller of shares must compute any taxable gain and the tax payable on that gain, and then compare the net yield from the sale of shares with the after-tax amount that would be payable in an asset deal. Individuals often prefer to sell shares because of the lifetime capital gains exemption available on the disposition of qualified small business corporation shares, which the 2024 budget proposes to increase to $1.25 million this year. A qualified small business corporation share meets these criteria if it is a share of a Canadian-controlled private corporation. The seller owned the share for at least 24 months before the sale. During the 24-month holding period, more than 50% of the fair market value of the corporation's assets were used principally in an active business carried on in Canada, and at the sale date, all or substantially all, which is generally 90% or more of the assets, were used principally in the active business. From the buyer's perspective, an asset transaction has the following advantages. The buyer does not inherit the seller's tax problems, although tax liens can attach to the assets. So that's why it's important to do searches at the due diligence stage to determine whether any of the assets are encumbered or whether there are any undisclosed tax liabilities of the target corporation or the seller. The buyer can be selective in choosing which specific assets and liabilities are acquired, and the buyer can write up assets to their fair market value, giving a higher depreciable base, subject to certain anti-avoidance rules. In other words, the buyer can write off the purchase of the assets over time. So the advantages to the buyer tend to be offset by corresponding disadvantages to the seller. Therefore, a seller may demand a higher purchase price to offset reduced net proceeds. At the same time, the buyer may be willing to pay more for assets than shares because the buyer may obtain a higher cost base on which to claim a capital cost allowance. This means the buyer can claim depreciation from its own adjusted cost base. Therefore, when negotiating the purchase price, the buyer should consider the present value of future capital cost allowance claims for the assets being purchased. The tax aspects of a share deal are more difficult to assess than those of an asset deal, and the buyer must analyze each of the company's underlying assets. The buyer's analysis should be informed by accounting or tax planning advice. The other type of tax to be aware of is sales tax. We're talking about goods and services tax and provincial sales tax. The impact of sales tax is an important factor. The sale of assets usually triggers the payment of sales tax. The Provincial Sales Tax Act imposes sales tax on tangible personal property and fixtures, as does the Excise Tax Act. Both statutes contain exemptions and elections which may reduce or eliminate the imposition of these taxes. In some circumstances, the buyer and the seller elect to not have GST applied to the sale of the assets. Such election applies where the seller is selling ownership, possession, or use of all or substantially all, usually interpreted to mean 90% or more, of the property required to carry on the business or part of the business. This is a joint election which requires signatures from both the buyer and the seller. By contrast, the sale or transfer of shares will not trigger the payment of sales tax, so the buyer will not have to pay this tax. So just a word of caution or some advice is to get tax planning or accounting advice as early as possible, maybe even at the letter of intent stage before you sign anything at all. I've done a few deals in the past where the contract came to me fully formed, or the structure of the deal was non-negotiable at that point, and our client failed to consider the tax implications of an asset versus share deal. So very important to get that advice at your earliest opportunity. There are employment and labor considerations in an acquisition or disposition, which include the buyer's obligations, asset versus share transactions, rehiring employees, employment agreements, and changing existing terms of employment. In a share transaction, all employment obligations to existing and past employees remain with the target clinic at closing unless otherwise assumed by the seller under the purchase agreement. The buyer typically inherits the employees of the target clinic and all existing terms of employment and all employment obligations on closing. In an asset transaction, the buyer does not assume any employment obligations to existing or past employees unless expressly provided for in the purchase agreement. The buyer is able to choose which employees, if any, to offer employment to, and typically will not have any obligations to employees who do not receive an offer of employment or who do not accept an offer of employment. Under the Employment Standards Act of British Columbia, the buyer will need to recognize statutory entitlements, but typically not common law notice or severance obligations. Generally, the sale of a clinic will not interrupt the employee's employment who are employed by the buyer after closing, with some exceptions, which include a gap in the term of employment or different employment terms. The buyer will need to review all terms of existing employment relationships, whether written or oral. If you currently have employees that do not have a written employment agreement governing, among other things, notice or severance entitlements, then it would be prudent to consider implementing written agreements but not without the guidance of an employment lawyer, or it could give rise to a claim of constructive dismissal. You have to follow proper notification processes or negotiate the revised terms directly with each individual employee anytime you wish to change the terms of employment. So just another word of caution, I did a deal recently where the seller failed to consider contingent employment liabilities and didn't have written employment agreements. So unfortunately, that was another situation in which I did not have an opportunity to advise on the letter of intent or the purchase agreement. And the contractual terms were quite clear that our client was required to terminate her employees on closing, and the new buyer would re-employ them after the fact. But the new buyer refused to commit to continuous employment, which means that our client was stuck with all of the liabilities up to and including the closing date. We didn't have written employment agreements limiting severance to Employment Standard Act minimums, which means that the employee might be entitled to common law notice. And we had some employees with very lengthy terms of employment, which would have resulted in some significant severance obligations. But fortunately, we were able to negotiate with the other side and create a plan to sort of mitigate the impact and the risk going forward. So just the word of caution is don't forget that your employees could carry liabilities that are going to be relevant either upon termination if you're closing down your clinic or upon transferring the clinic to another owner. And if you have an opportunity to review your employment agreements, I strongly suggest you do so now, but do so very carefully, because oftentimes when a written agreement is implemented after the employment relationship has already begun, it needs to be done so very carefully. It's very easy to give rise to a claim of constructive dismissal in that situation. So make sure you review your employment agreements. If you don't have any, please contact a lawyer and see if you can get some in place, and then follow the instructions for implementation very carefully. And then certainly don't, if you have employees, or in any event, have the purchase agreement reviewed by a lawyer before you sign anything, because there could be issues that you or your other professional advisors, whether you're using a business broker or what have you, that are not aware of those things. So, and finally, some notes on the College of Physicians and Surgeons of British Columbia's requirements for leaving practice. So the College of Physicians and Surgeons of British Columbia set up practice management considerations to ensure the continuity of patient care and the preservation of patient records in situations where registrants cease to practice, take an extended leave of absence, or close or relocate their medical practice. And that practice point governs notification, medical records, patients requiring ongoing care, and return of pharmaceuticals. So in terms of notification, the college requires physicians leaving practice to provide notice to patients as early as possible to allow them to make alternate arrangements, and recommends a minimum of 3 months. Notice efforts should be well documented and include the physician's proposed departure date, how the patient can access medical records, and whether another physician is taking over the practice, or whether other physicians are accepting new patients. It's important to protect patient information and privacy in the process, and it will also be necessary to notify other individuals and agencies involved in the management of patients. With regard to medical records, a departing physician will be required to make arrangements to either retain or transfer patient medical records. If the departing physician retains a patient's medical records, then they must provide patients with access to their medical records upon request. If the departing physician transfers a patient's medical records to another physician or medical records storage facility, then they must provide the college and patients with the information necessary to access their medical records. So in a disposition of a clinic, it might not be possible to provide the full 3 months notice. We've certainly seen issues with that in the past, especially if there's some sort of cogent business reason or what have you to not disclose that information publicly in the case of an acquisition or disposition. But it is definitely important to notify the patients as early as possible, advising them that a new physician is taking over the practice and how they can access their medical records, and informing them of their option to make their own alternate arrangements. As you probably know, that sure, you can sell a clinic, structured as a business, and the revenue is coming from the patients, but ultimately there's no real rights to the patients. They'll always have their right to seek other care. So patients requiring ongoing care, a departing physician must identify patients who are under acute active treatment and make reasonable efforts to place them, and document same and arrange for follow-ups. That's much easier to do if you're not closing down your clinic and you are actually transferring either your interest in a clinic or the entire clinic to one or more other physicians that should cover you on reasonable efforts to place them. And then the final consideration is the return of pharmaceuticals. Departing physician must also make arrangements to either properly dispose of pharmaceuticals or transfer them to another physician. For this piece, I'm going to suggest that you don't do either of those things without consulting a legal professional or a practice advisor on a case-by-case basis. So that is all of the content we have prepared. I'd be happy to take any questions that weren't answered during the presentation.
I'll give it a minute so for people to type in their questions in Q&A, and I just want to address some of the questions in the pre-questions. There were a lot of text questions and about finding buyers for your clinics. So you should reach out to your accountant for any tax questions, and for buyers, your local realtor.
Yeah, I think you might also consider engaging the services of a business broker. Some realtors do have sufficient experience in buying and selling active businesses or active clinics. But I do know that there are business brokers out there who specialize in healthcare facilities. So that might be a better option.
And there was a question in the pre-question, if there are any resources through Doctors BC to assist with the cost of moving a practice on like phone lines, internet, EMR. So under your membership Club MD, there is preferred rates with the phone internet with the TELUS program. And as well as we partner with MedRecords for your EMR storage. So members do get prorated fees and limited amount of free storage. So to reach out to their representative if you require EMR storage services, and you can find their contact on our Closing Your Practice page on Business Pathways. And I want to add that if you're unsure about any stage of your practice, our regional business advisors are up and running now, so you can definitely get in touch with them through Business Pathways, and they can help you with your options, resources, and referrals based on your unique situation. Now on to some questions. So what type of liabilities that employees can carry that buyer or seller need to keep in mind?
Yeah, no, that's a great question. So the main ones are accrued benefits and vacation entitlements, and then severance. So severance is a big one. So the Employment Standards Act sets out minimums for severance, but unless you have an employment agreement that limits severance, so it's notice or pay in lieu of notice is what I'm referring to as severance. The Employment Standards Act sets out basic minimums, but unless you have a written employment agreement that limits your employee's entitlement to those minimums, then they likely are entitled to common law notice or payment in lieu of, which can be a significant amount of money, depending on a number of factors, which include the employee's length of service, their age, availability of suitable alternatives, yes, or the job title, that sort of thing. So in one of the situations that I ran into in the past, we had a very long-standing employee who was entitled to, by our calculation, a significant amount of money that equated to a large chunk of the purchase price, which the client was unaware of. So this is definitely, we have, I know that Sarah from our office has done webinars on employment stuff before, and we can provide further guidance on this. But what I will say is that if you don't have a written employment agreement, it's very important to reach out to an employment law specialist to discuss implementing them now. It might take time, and there will need to be fresh consideration, but this is certainly something that you should get out ahead of now. In the last situation we were in, we had sort of a tight turnaround for closing the transaction. And if we didn't close, we would have been in breach of contract. Again, I did not draft the contract. So that was a major concern. If we had a greater period of time to actually provide notice that the employee's employment would terminate on closing and that they might get an offer from the buyer, then we would have been significant. The liability to the seller would have been significantly less, but there was no sort of pre-planning involved in that, and it was quite an experience to try to sort out in the 11th hour.
Thank you, Mitchell. Hope that answers your question, Nora. The next question. Let's see. If a specialist physician does not provide primary care or have any patients on an ongoing basis, who should be informed besides the college and referring physician about this decision to leave and retire?
Primary care. That's if I'm reading the question correctly, your notification requirements are probably quite limited in this situation. You're correct in the sense that you should inform the college, but if there's absolutely no patients, then you might not have any further notice requirements. The question then becomes, are you still retaining the records or patient records, even if they're not sort of active patients? Then you might have an obligation to transfer those records and still inform your former patients. But it all sort of depends on exactly what the situation is. But no, the main issue is active patients. And then if you're providing ongoing care, then there are other sort of entities to inform, especially if you're expecting, lab results or what have you, then that would be the case. But if you want to have a more specific conversation about exactly what the facts are, I'd be happy to give you a more concrete answer on that. And you can reach out to me at any time and I'll arrange a quick consultation. No problem.
Thank you, Mitchell. Next question. Given the shortage of specialist physicians, what does the retiring physician do if no one will accept their ongoing management patients? Can they be sent back to the GP to find the next appropriate specialist?
Given the shortage of specialists. I mean, that's a good question. You could certainly try that. I mean, you're required to make sort of reasonable efforts to find our alternative care to that sort of patient for sure. But then the question becomes, to what level are you required to go? I do think that if you make reasonable efforts and document those efforts correctly, and if you refer them back to their GP to find an appropriate specialist, I think that you've probably discharged your duty in that situation. But it really depends, I think, on the situation. But no, you're not stuck with them in the end, I guess is what I'm trying to say. It's just, did you make reasonable efforts? Did you document those efforts? And then did you notify the college?
Thank you, Mitchell. Definitely do keep records of what's happening. Perfect question in the chat. Can you sell goodwill?
Definitely.
Okay.
Yeah. So goodwill is an intangible asset. It's typically not sold on its own, but it's a lot of what you're selling in a lot of situations. So goodwill is sort of linked to the patient base, or in a non-clinic situation, the customer base, the branding, just the sort of revenue production. So yeah, typically you would allocate part of the purchase price to goodwill in any situation. It's definitely a marketable asset. So I touched on this before, but if you're thinking about, creating multiple clinics or expanding, that branding will be important when you're going to sell goodwill as well.
So the next question, a follow-up question to that goodwill question. What is the tax consequences?
On selling goodwill?
Yes.
So it kind of depends. There will be, so if you're selling all of the assets, like if a corporation is selling the assets, then there's capital gains involved in that, and sort of all of the assets will attract that. And then you'll pay income taxes if the corporation distributes that funds to the shareholders. But goodwill is an intangible asset, so it's not like equipment or personal property or that sort of thing, so it won't attract GST or PST.
Thank you, Mitchell. Next question. What are my first steps when I know I want to sell? Who do I see first, in what order, and then how do I find a potential buyer?
Yeah. Okay. So that's a good question. It sort of depends on the circumstances. I would start by consulting my accountant and seeing if you can determine what sort of value the corporation has in it. And then you might wish to list the clinic with a business broker, or reach out to your network to see if there's an interested buyer. But the first steps are really just, finding out what, if any, value there is to the assets or to the sort of clinic itself, and whether it's truly marketable, because it isn't always. And I think we had a question in that was provided to me previously. And there are certain situations in which you might not get a significant amount of money for your interest in a practice or in a clinic. If it's not necessarily generating a significant amount of revenue, or if it doesn't have an asset base of value. So I think the first question is determining whether you have something that you can actually market and that you could sell. And then from there, it's about finding a buyer. And then from there, it's you'll enter into an LOI and a purchase agreement. From the seller's perspective, though, it's about sort of getting everything ready to be transferred or assigned. The legal stuff, you'll have to get the corporate records in shape, and then the assets prepared to be transferred. But I would start with my accountant.
Great tips, Mitchell. I think that's all the questions we have currently. I'll give it another minute if you're typing up the questions, Matley. There's a follow-up question to that goodwill question. Can you sell goodwill from personal ownership yourself to a new corporation which you own all shares?
Yeah. Okay. So the goodwill thing is tripping me up a little bit because we're only talking about goodwill. But typically, if you've started out as a sole proprietor and like an unincorporated entity, then you're going to want to do some tax planning before you transfer any of your assets from yourself or from your personal name into your corporation. But yeah, I mean, I don't know what it depends on what the goodwill is in that situation, right? Maybe. I think that this might be a question to take offline and sort of drill down a little deeper and figure out what the facts of the situation are before I provide again a more concrete answer on that.
Thank you, Mitchell. I hope that answers the question, Frank. And if you need a consultation, to reach out to Mitchell. Not seeing any more questions on the Q&A or the chat. Okay, here's a new question. How do you retain staff while you are trying to close the practice if you're mandated to give 3 months notice to all stakeholders? Staff will want to find the next best employment.
Yeah. Okay. So, I mean, that's an interesting question for sure. It sort of depends on what the plan is as between the seller and the buyer. Like if you've got someone on the other end who's coming in to take over the practice and they're giving offers of employment to all of your employees and it's on all the same terms and conditions and they're getting paid the same. Often what we see in practice is that no one actually leaves. So depending on the relationship you have with your employees and the specific situation within your clinic, it might not be that great of a risk to provide that notice up front. But yeah, I think retention is the same regardless. It's about creating an environment that people want to stay in both before and after the closing. Yeah, I think typically people don't get scared off when they know that someone, is coming in to take over and they're prepared to provide all of the same things and things are going to remain as the status quo. Then we haven't seen that sort of issue in practice anyway. It's definitely something to think about. But it hasn't proven to be a significant issue in practice in my perspective.
Thank you, Mitchell. A follow-up is, what if no one's buying your practice and you're closing it completely? Do you have comments on how to retain those staff for those 3 months of notice?
Oh, okay. So you don't have to give the staff 3 months, or why are we retaining the staff for 3 months? Sorry, where's the question?
Oh, the question is in the Q&A. I think it just means like if the staff knows that you're closing your practice within 3 months, then they would be looking elsewhere for employment instead of staying for the remaining 3 months.
Oh, instead of like if you're closing the clinic and required to give your patients 3 months notice that they need to find a new provider, how do you keep your staff on board for those 3 months? Yeah, I actually haven't encountered this issue in practice before. And to be honest, I'm not sure that this is necessarily a legal question. But I think, yeah, that's certainly a concern. I mean, the obvious answer is the same way that you sort of retain anyone in that situation. It might cost money, right? You can employ certain retention strategies like, letting your staff know that employment will end in 3 months, and then hopefully you've discharged your notice or your notice requirements under the ASA or that's the Employment Standards Act, or your employment agreements. But you could also provide additional consideration, like a retention bonus or what have you, for those staff who commit to sticking around right until the end. In that situation, 3 months is not a significant period of time either. So your staff might wish to use that time to actually obtain a new position. I'm not sure exactly how long it takes to hire staff within the industry, but I know it doesn't happen overnight. So that might be a bit of a saving grace there as well. But I think it's just about giving people a reason to stick around for those 3 months. The other thing is that you might be able to function with less of a staff in that situation. I'm not sure. You could hire temps. I think it's probably across that bridge when you come to a situation. But if you'd like to discuss sort of strategies, I'm happy to have that conversation as well.
Thank you, Mitchell. I know that was a little bit out of your realm. Thank you. So I don't see any more new questions in the Q&A. Maybe I'll give everyone back some time in their day. So thank you, Mitchell, for taking some time to educate us on clinic options. And thank you everyone for attending this evening. If you can complete the survey, please do so. June has quite a few webinars up for registration on Business Pathway as well on audit and billing, as well as 2 sessions from Dr. Kevin Lee's point of view on how to run a practice and financial management. So do check it out. And with that, have a good evening, everyone. Thank you for attending.